Today was one of those days on Wall Street, just brutal. A sea of red washed over the screens, and according to a new institutional strategy report, this wasn't just a bad day. It's a sign that the fundamental rules of the market have completely changed. So let's dive into what happened, and maybe more importantly, why.
First up, just look at the numbers. The tech-heavy NASDAQ 100, home to all the biggest growth stocks, it just got hammered. It plunged nearly 2.5%. That's a huge warning shot right in the market's engine room.
And the pain was, well, it was everywhere. The broader S&P 500, which is basically a report card for the entire U.S. economy, wasn't far behind, dropping a really steep 1.74%. I mean, there's almost nowhere to hide today.
And get this, even the market darlings, the stocks that seemed totally untouchable, they got hit hard. NVIDIA, the undisputed king of this whole AI boom, fell over 4%. Wow.
But the real shocker? You gotta see this. Meta, the social media giant, just cratered, losing a staggering 8% of its value in a single day. I mean, that's not a dip, that is a rout.
So all of this brings us to the big question, right? What on earth is actually happening? For years, investors followed a pretty simple playbook, but today, it feels like that playbook was just thrown right out the window. So why? And this is the core idea from the report. We are witnessing a fundamental shift in how the market thinks. For over a decade, we all lived by this mantra that bad is good. But according to this analysis, that era, it's officially over. So what replaced it? Well, there's one word that is absolutely haunting the markets right now: stagflation. And this is really the key. Stagflation is this toxic economic cocktail where the economy gets weaker, growth slows down, but prices just keep going up. It is literally the worst of both worlds.
And this slide just lays it out perfectly. Under the old rules, bad news about the economy was actually good news for stocks. Why? Well, because it meant the Federal Reserve would step in, cut interest rates, and flood the system with cheap money. But the new rule, bad news is now just bad news, period. Inflation is so high, so sticky, that the Fed's hands are tied. They just can't come to the rescue anymore.
So what's actually triggering this fear? Well, the report points to four main things. First, you've got this geopolitical shock that sent oil soaring to $95 a barrel. Then, on top of that, the OECD just massively hiked its inflation forecast for the US. And third, the jobs data is still strong, which sounds good, right? But it actually means the Fed can't cut rates to help the slowing economy. And finally, all of this has forced the market to accept that those rate cuts everyone was hoping for in June, they're now pushed to September, or maybe not even this year at all.
But here's the thing. Don't make the mistake of thinking this is just about stocks. The report makes it crystal clear that this new stagflation fear is causing a systemic panic, and it is spilling over into every single corner of the financial world. I mean, just look at this chart. It's fascinating because it shows just how broken things were today. Stocks, right, the S&P 500, they were down hard. But look at gold, the classic safe haven you run to in a crisis. It was also down over 3%. The only thing that went up, the energy sector, the very source of the inflation problem to begin with.
So why on earth would gold fall during a panic? The report explains it with this quote. Basically, the normal relationships between assets are breaking down. When you're facing huge losses, you don't sell what you want to, you sell what you can. People are being forced to liquidate their winning positions, like gold, just to raise cash and cover their losses somewhere else. It's a huge sign of forced selling and deep distress in the system.
So, where do the pros stand in all this chaos? You might think there'd be some kind of consensus, but the report shows a really deep division among the biggest names on Wall Street.
It's basically a civil war of ideas. In one corner, you've got Goldman Sachs saying, hey, this is a buying opportunity, and that long-term trends like AI are still solid. But in the other corner, you have JP Morgan sounding the alarm, telling clients to secure cash now because systemic risk is going up. I mean, two of the smartest firms in the world giving completely opposite advice.
And that uncertainty leads us to two very different paths forward, and the market is balanced on a knife's edge between them. On one hand, you have the bull case. Scenario A, a ceasefire could send oil prices tumbling, and those beaten-down tech stocks could roar back to life. But then there's the much darker bear case. Scenario B, oil spikes even higher, key financial levels break, and the automated trading programs kick in, triggering a downward spiral.
And just when you think you've got a handle on all the risks, the report ends with a pretty chilling warning. It says the biggest danger out there isn't inflation, or oil, or even the Fed. It's something lurking in the shadows of the financial system that almost no one is talking about.
So the final question the report leaves us with is this. While everyone is staring at inflation and public markets, could the real crisis, the next black swan, be hiding in the shadows? In the massive, less regulated world of private credit, where these non-bank lenders have been handing out huge amounts of corporate debt. Is that the ticking time bomb that could kick off the next phase of this crisis? It's a crucial question to think about, because as we've definitely seen today, the old rules no longer apply.